The domestic economy here in the United States is doing terrifically. And that does look insulated from what is happening in the rest of the world, the slowdown in Europe, the slowdown in China. We're ultimately trying to consider what is the best way to play the domestic strength here in the United States. If it's not small caps, what is it?
Well, if you're a trader and you like the small cap trade, that's fine. But if you're a long-term allocator, don't allocate to small caps. In terms of what the best trade right now is, I honestly think at times a cash position is interesting, especially when you finally can get some yield on your cash because short rates have gone up so much. And that doesn't mean I'm an uber bear by any means. No. It simply means that at this particular time, I'm quite cautious.
But Jason, for a lot of investors out there, if they called you up and they said to you, look, the domestic economy here in the United States is doing really, really well. How do I play it? If you turn around and say Treasury bills, they're going to put the phone down, aren't they?
Yeah, that's right. I think cash is an asset class now, which it hasn't been for a long period of time. But again, I think alpha is going to be much more driven not by timing the market, not by beta. It's going to be driven much more by stock selection. And this is always a cop-out for a top-down analyst to say it's a stock picker's market. But I do think part of what Peter has said, you do have a good portion of the Russell 2000 that haven't earned money. 35% of the Russell 2000 hasn't earned a profit in the last 12 months. That suggests to me, as interest rates rise, that you're going to have much greater dispersion in returns, and you're going to have a much better chance as an active manager of actually beating the index. That's the good news. The overall market might not do as well because, in my opinion, the real economy is competing with financial assets for liquidity. First time that's happened in a long time. But there are a lot of opportunities for, I think, professional money managers to make money.
Lisa?
I think it's interesting how much hand-wringing there is in equity markets right now and how much caution there is, particularly with respect to companies that are over-leveraged, when you're not seeing the same caution in credit markets. This is a fascinating dynamic to me because usually people in credit are the worriers. They are the ones who are always predicting doom and gloom. They are typically the canary in the coal mine.
The first mover.
The first mover, they're not chirping. They're not concerned at all. Spreads have actually been tightening. You've seen triple C's outperforming double B's. You know, so I just have to wonder, does this mean that perhaps there's too much caution in certain pockets of the equity markets? I hate saying that. It makes me kind of feel terrible inside. But I think that you know, that seems to be one implication out there.
Lisa?
I mean, I agree that it is very, very interesting. But we also have to realize the equity markets had a heck of a run when credit markets stood still for a while. So if we look at something like the HYG, which is the ETF for high-yield bonds, it really hasn't moved very much at all for 6 to 9 months, whereas equities continued to make new highs. So to some extent, you could make the argument that, in fact, credit investors have been cautious for a while. It didn't make the move higher, and so therefore it hasn't moved lower. But I agree with you. Default rates are still low, and I think that's a very important part of this because even though interest rates are higher and risk-free interest rates are higher, high yield is still a very attractive place to be globally, especially when you have emerging market corporates and sovereigns not performing well. There's a migration into U.S. high yield, so it's part of that rotation.